So in the last video, we talked through your first trade, how to fund an account, how to read an order book, how to actually place a position and exit it. We kept it mechanical on purpose, because the moves themselves are simple. You click buy, you click sell, the platform handles the rest. But here's what we didn't talk about. What happens to the money after you start clicking? How often new traders actually win? And what the math looks like once the real dollars are sitting in real position. This video is a part of a completely free course on how prediction markets work. Every module is available at predictionist.com. Link is in the description. So let me start with a number that almost nobody in the space wants to say it out loud. We covered it in the previous sessions. Most people who trade prediction markets lose money. Not a few, not the unlucky ones, most. The comprehensive analysis of about 2 million polymarket wallet addresses found out that roughly 70% of all users record net losses. The median retail return between mid-2025 and early 2026 was a negative 8%. That's even worse than the median sports bettor over the same period, who was down about 5%. And the profits that do exist on those platforms are radically concentrated. Fewer than 0.04% of all wallets capture more than 70% of total gains. So when you place a trade, you're not really trading against the crowd, you're trading against a very small group of people who are very good at this. Now, I'm not telling you this to scare you off. We run an entire channel about prediction markets. We think they're one of the most interesting financial instruments to come along in years. But every other source covering this space, the platforms, the influencers, the I made 40K on polymarket thumbnails, have a financial incentive to make this look easier to you than it is. We don't. And if you're going to put real money on the line, we should see the actual landscape first. Let's go a little deeper into who is losing, because the pattern isn't random, the data breaks down cleanly by account size. So, accounts under $100, the median return of a negative 26.8%. Accounts between $100 and $1,000, negative 12.4%. Between 1,000 and 10,000, still negative, about 5%. The only group that constantly makes money are wallets over $500,000. They're up about 2.6%. Read that again because it matters. The smaller your account, the more you lose. Not slightly more, dramatically more. If you're starting with $50, the math says you'll lose about a quarter of it, just by participating. Why does this happen? It comes down to who is on the other side of the trade. It's not other beginners, it's quantitative funds running models you can't see. It's market makers earning spread you're paying. It's well-capitalized traders who can absorb a losing streak and would wipe out a small account out in a week. They're not smarter than you in some abstract way, they just have structural advantages that compound over thousands of trades. And that's not an insult. It's just how the market is built. So step 1 is seeing it clearly. Step 2 is figuring out how not to feed it. Now, there are 6 distinct categories of risk in prediction market trading. The first one is capital. And this sounds obvious until you think about it carefully. Prediction market contracts resolve to either $1 or $0. There's no middle. If you buy yes at 70 cents and then the event doesn't happen, you don't lose 10%. You lose everything you put in. Compare that to a stock. Apple has a bad quarter, you might lose 10 to maybe 15%. But to lose 100% on Apple, the company has to collapse entirely. To lose 100% on prediction market trade, the event just has to go the other way, which it doesn't roughly half of the time by design. So every trade you make has to be sized with an assumption that you could lose the entire amount, not as a trail risk, as the normal expected outcome on the losing side. The second risk is resolution, and this is the one new traders never see coming. Let me give you 2 real examples. In 2024, there was a market on Polymarket asking whether Zelensky would wear a suit to a specific event. It initially resolves to yes. Traders who bought yes celebrated. Then the resolution got disputed through the platform's Oracle system, and it flipped to no by a token holder vote. People who were factually correct about what happened in the real world lost their money. There was another one. Will Trump say the word China during a specific address? He'll literally say China out loud on camera. The market still resolve no because of an retroactive clarification about the context the word has to be spoken in. These aren't edge cases. Being right about reality is not the same as being right about how the market resolves. So before you put money on anything, read the full resolution criteria, not the headline question, the actual rules. Who decides what counts as the event happening? What source do they use? What's the deadline? If any of that feels ambiguous, skip the market. There's always another one tomorrow. The third risk is you, specifically your brain. Binary outcomes that resolve in days or hours hit the same dopamine circuits as a slot machine. This is well documented in the research of gambling. And it shows up in prediction markets in three main patterns. The first is revenge trading. After a loss, you feel a strong urge to place another trade immediately to win back what you just lost. Statistically, those traders have significantly worse expected value when the trades you place when you're calm. The second is the sunk cost trap. You bought yes at 60 cents and now it's trading at 30. The new information strongly suggests you were wrong, but you won't sell because you invested 60 cents. That 60 cents is gone either way. The only useful question is, would you buy this contract at 30 right now? If the answer is no, get out. The third one is emotional attachment. If you're trading on a candidate you support or a team you love, you're almost certainly overestimating the probability of the outcome. You're not analyzing anymore, you're paying to feel something. And there are cheaper ways to do that. Okay, so that's the landscape. If you watch this far, you still want to trade, let me leave you with the one rule that does more work than anything else. Never trade with money you cannot afford to lose completely and permanently. Not lose temporarily and make back, loss, gone forever. If 70% of traders lose money, you have to assume your starting bankroll is tuition, the cost of learning. If you got $200 to work with, your maximum per trade is $10. That sounds painfully small, is it? Well, that's the point. With 5% sizing, you can lose 10 trades in a row, which will happen at some point, and still have most of your money. You can keep learning, you can keep trading with 25% sizing, 3-bet trades, and you're done. And once you're out, you can recover anything you learned. So, here we are. Most prediction market traders lose money. Small accounts lose the most. The people constantly making money are well capitalized professionals. And the single most important skill in this whole game is finding good trades. It's sizing your position so the inevitable losses don't end up your run. If you walk into this video thinking prediction markets were easy money, I hope you're walking out thinking something different. In the next video, we go through how to actually choose the right platform for where you live and how much capital you're working with. So see you there.